The BIS warns that US trade policy risks a global financial panic. The Bank for International Settlements has warned that resurgent US inflation could unfold due to President Trump's trade policies. The annual report highlighted how the Fed may encounter an especially hard time in the current environment. So, with 9 days left until Trump's July 9th tariff deadline, how will the US Central Bank cope? Paul Hollingsworth is head of Developed Markets Economics at BNP Paribas. Paul, the Fed's preferred inflation reading surprised to the upside in May. Are reflation fears warranted?
We think the fears are warranted. Our long-held view here has been that inflation would pick up on the back of these tariffs that are being introduced. Now, it's true that so far we've seen very limited evidence of this come through in the hard data, but we put that down to two reasons. Firstly, firms had built up some inventories ahead of tariffs, so they had a bit of a stock that they could run through without having to make decisions when it came to pricing. And a second reason is simply just the uncertainty created by the volatility of policy announcements, we think has led firms to take more of a wait-and-see approach until there was more clarity. But we now think that we're getting to the point where firms will be forced to take those decisions, including on pricing, having used through their inventories, and potentially with a little bit more clarity on trade coming over the next few weeks. And so that, in turn, in our view, means that over the summer months, we should start to see more of an effect come through from tariffs in US inflation.
The June employment report released this Thursday is the next focus for the Fed. What are you expecting?
We're looking for a 125,000 gain in payrolls, a little bit above the current consensus estimate. And our estimate of the break-even rate of payrolls at the moment is somewhere between 100 and 150,000, meaning that this should be enough to keep the unemployment rate stable at 4.2%. So, cut a long story short, we don't think there's going to be much in this jobs report to really panic the Fed or induce it to cut rates particularly early.
So do you think a July cut is on the table? And what's your outlook for rates?
We don't think a July cut is on the table. If we look at the comments from Fed Chair Powell very recently, he indicated that the Fed really wants to see both the June and the July inflation data to see if there are some signs of tariffs coming through. That really closes the door to a July cut in our view and probably puts September as the most likely live meeting. However, as I already mentioned, that our view is that inflation will come through over these summer months. And so our view is that the Fed will actually keep rates on hold this year as it faces that tariff-induced inflation and has to balance that against the growth outlook.
Traders are boosting bets that the US 10-year yield will dive towards 4% in the coming weeks. Do you think this is a likely outcome?
We've been more positive than the markets on treasuries for a little while now, and it seems that the market is catching up a bit to our view. And one of the reasons behind this view that we've held is that we see the US administration as being bond vigilant, or at the very least sensitive to the bond market, and that's provided a bit of a cap there for long-dated yields. Now, the most recent moves we've seen, I think, have predominantly come on the back of the more dovish Fed speak, and that's important because it means although we've seen a bit of a bull steepening when it comes to the curve over the past week, we think from here, if we're right in thinking that the Fed does not cut rates this year, there's actually a bit of scope for more of a bull flattening move.
Trump said that he would choose a Fed chair successor that wants to cut interest rates. So with the announcement due soon, would the market pay more attention to a shadow Fed leading up to the end of Powell's term?
I think the broader question here is the extent to which the political pressure that we see on the Fed will in any way affect its reaction function. And our view is that it won't. In other words, if the Fed was to start cutting rates earlier, it will be because of the economic data rather than because of any political pressure that may be there. And so in our view, the two ways that we might get earlier cuts than in our central case is either because the tariff-induced inflation doesn't come through, or second, that we see a much more weakening environment in the economy, which means that the Fed would be able to look through any temporary pickup in inflation. That's not our central case, but in our view, that's the route to earlier Fed cuts as opposed to any political pressure.
Paul Hollingsworth, head of Developed Market Economics at BNP Paribas. Don't forget, you can watch more videos on Reuters.com.